Actually, well, now that I'm gonna go to like Ross or whatever, I'm gonna go down and go put some new pants today. I'll put down there.
Ask if I can hear you.
All right, is anybody, can somebody just confirm that they can see and hear, see the thing that says bonds and then hear me?
Yep, I'm good.
Cool.
First thing, can you sit here and help Josh?
I don't know how to do that.
I can help you.
What?
Let's talk about bonds, mortgage bonds. You know, we're going to discover how the bond market really works. And I think that by understanding this, this will help you as an investor in your own portfolio. It'll also help you with your clients and really understand the intricacies of how the bond market works, how it affects the day-to-day, give you such an advantage over your competition because, quite frankly, they don't understand it. So let's go. First of all, we know that mortgages are based on mortgage-backed securities, but treasuries matter. And treasuries have different maturities. That's simply how long that treasury will be out there. Now remember that treasuries are backed by the full faith and credit of the US government, and because that's the case, they're considered to be a risk-free investment. Now it's not risk-free as far as pricing goes, but it's risk-free as far as the fact that you'll get your money back. That's a big thing. You see, other bonds, corporate bonds, could be in a company. If that company goes bankrupt, you've got a bond, but it can become worthless. The full faith and credit of the US government behind treasuries is what allows them, first of all, to charge a lower yield or to offer a lower yield because of the fact that there is less risk of default. So different maturities have different names and people get them wrong. So if the maturity is 1 year or less, it's called a treasury bill. Now, if the maturity is greater than a year, up to 10 years, it's called a note. Now, you know that we look at the 10-year treasury note, but so many people get it wrong and they say it's a 10-year bond. No, it is not. When they say that, it just shows their inexperience because they don't understand the names of the different levels of maturity.
I actually have to run. I have this meeting that I have to pay attention to.
Than 10 years,
For a second.
that's a bond. Now, when you take a look at a 30-year treasury bond,
Weekend.
it can
I'll
have
see you
30
Tuesday.
years from its inception, but maybe it might have been 10 or 20 years past, so therefore it might only have 20 years left or 10 years left or 5 years left until it matures, till it pays off, even though the maturity that it has remaining might be less than 10 years or even less than a year. It was still initially sent out as a bond and it will always be called a bond. So once again, maturity of 1 year or less, that's a bill. Treasury maturity greater than 1 year, up to 10 years, that's a note. Greater than 10 years, that's a bond. Now, as I mentioned to you earlier, because they're backed by the full faith and credit, they're considered risk-free from the standpoint of the maturity being something that the government will back to make sure that you get your money. However, in between, there could be, if you sold it in between, so 30-year bond, it might vary in price a year afterwards, 2 years afterwards, 5 years afterwards, 10 years afterwards. But at the very end, if you have a bond that's for 30 years at $100,000, you're going to get back $100,000. So therefore, it is risk-free at maturity, but the price can vary along the way. Now, the way that bonds work is they're a way to raise capital. Look, I've got a business. I want to raise money. I'm a government, and I don't have any money, so I've got to borrow some or create some. So what do? I sell bonds. It's a promise. See, equity could be raised if you have a business and you want to try and sell some of that business, but a bond, it's a debt instrument. In other words, I'm not selling any ownership, but what I'm doing is I'm giving you a promise to pay you back. Now, bonds have what's called a liquidation preference. Why is that important? A liquidation preference means that this bond, should things go bad, should things go sideways, let's just say if it's a corporate bond, if there's limited amount of funds remaining, the bondholders get paid first, and only if there's anything left over after the bondholders get their money will the equity holders receive their money. Now, the issuer of the bond, whether it's a company or a government, they owe the investors the face value of the bond at maturity, and they pay interest, which is known as the yield. There's two components to the bond. One is the price and one's the yield. Kind of like on a seesaw. There's an inverse relationship. And you see this in your pricing sheets. If bond prices go down, causes interest rates to rise, and vice versa. Bond prices go up, your rate sheet pricing gets better, it's because interest rates are going down. So you get that inverse seesaw relationship between the two. Now, there's the 10-year Treasury note, which is often quoted as something that mortgage rates are pegged to. Wrong, they're not pegged. But they do move together kind of directionally over time, and we'll show you that. You know, the way that you could kind of look at it is if you have a specific stock that's a component of, let's say, the Dow or the S&P. If the S&P is having a great day or the Dow is having a great day and this is a component within that, chances are the stock will be doing well, but it isn't necessarily going to move in lockstep or along the same percentages. That's how the 10-year Treasury should be viewed, as a barometer of, more often than not, the right direction, but not necessarily how good or how bad. When it comes to mortgage rates and mortgage pricing, you have to go based on mortgage-backed securities. Now, the 10-year Treasury does tend to compete for the same investment dollar as mortgage-backed securities go, because mortgage bonds and the 10-year Treasuries have somewhat of a similar, what's called duration. Their mortgage bonds sometimes will have a lifespan or a duration nearing 7, 8, 10 years, not too far off where Treasury notes are. Now, although the 10-year Treasury is a good barometer, as I mentioned, you have to look at mortgage-backed securities in order to get mortgage-backed security pricing. So let's talk about different components of the bond. So the nominal interest rate, that's the interest rate before taking into account things like any fees or compounding interest. It's just the coupon rate. So if you have a bond that's going to pay 6%, well, that's the nominal rate. But over time, if you let that compound, it would have a greater compounded yield if you kept reinvesting your dividends. But the nominal rate, that's the coupon rate. That's what it says on the bond. Now, the real interest rate is what's measured by the bond's buying power. In other words, it takes into consideration the rate of inflation. So when you take into consideration inflation over time, if inflation's high, that's going to eat into the bond's buying power, because remember, you're going to get a fixed payment on that bond, and it will buy less and less and less if inflation.
I wanted to touch on something, guys, real quick, because he was just talking about the somewhat correlation between the 10-year Treasury and mortgage bonds.
Correct.
So usually the news is always going to report the 10-year Treasury. We talked about that before. It's expressed in yield, so it's expressed in rate. So it's just a lot easier for them to explain to most consumers that know nothing about the bond market.
Stuff up, down.
Up and down, yeah. So today's a good example, because you might hear, okay, right now the 10-year Treasury is down 7 basis points, which means that rates are moving in the right direction if you're looking at the 10-year. But the 4.5% mortgage-backed security coupon, which is what we're currently kind of pricing off of, that's like 5.5% rates, but that's down 12 basis points. So the yield on mortgage-backed securities is up, but the 10-year is down.
Uh-oh.
Yeah, so it's not always perfect, but you can get a situation like this where somebody's following the 10-year Treasury and they're like, okay, well, the 10-year is down 7 bips. Why are rates not looking much better on your rate sheet, or better at all? Maybe possibly slightly worse than yesterday. It's because there's not always a direct correlation. They're closely correlated, like in the way that he said, but
Okay, so for our purposes, there's no reason to be following the 10-year necessarily.
well, there is, yes, because typically the 10-year will help. I mean, when we're following the 10-year, if the 10-year is trending in a certain direction, mortgage bonds will typically follow, and vice versa, just because, again, it's competing for the same investment dollar, or the same fixed income type of investment, but it's not always directly correlated. So it's just be careful if people are watching the news. They may think that that rates are coming down like today, but they're not really. So just
Yeah, while we're paused here, the real interest rate, because I think this is pretty appropriate for now. How does that work? Like with kind of right now, the real interest rate, not interest rate with inflation rate up at like 9%, 8%.
So when we're calculating, I mean, usually if you're looking at like macroeconomics from like different perspectives, you're going to take into account inflation. But for what we're doing for our job, we don't need to calculate. This is just kind of give you an overview. Yeah, most people just don't understand like inflation weighting and like real rate of return versus nominal rate of return. So don't worry about that too much.
That's just an abstract thing, like someone like buying a bond, they can just think about it that way.
Well, that's what they all are thinking about. So that's why when inflation goes up, the real rate of return comes down. So they need a higher a higher nominal rate of return to offset. Exactly. So you're taking
Inflation goes up over time. The effective interest rate, that's going to consider the compounding effective interest, but you can only compound that interest if you reinvest the interest that you're getting. Then it will have a compounding effect. If you take it and pocket it or spend it, there's no compounding. But if you say, hey, I'm getting the interest on this, let's reinvest that or put that back in, there is a compounding effect. So that's the effective interest rate that you get. Now, the coupon rate or the nominal rate, that determines the interest payment that is made to the bondholders either annually or semi-annually, and that's their compensation for loaning the money. So if you have a bond that's issued for $100,000 with a coupon of 4%, well, 4% of $100,000, that's $4,000 a year. That's your return. Now, you could be paid that semi-annually, which is very common in bonds. You could be paid it annually, or sometimes you could even get it paid monthly. So let's talk about the bond price and how it impacts yield. This is a really important topic for us to cover here, so please pay close attention. When you take a look at a bond, its par value, I may have heard par, or it represents 100%. I know you see this on your rate sheet when you see par. What does that mean? It means that if the promise, that bond is issued for $100,000, over time, that can potentially fluctuate. People might pay a premium, people might pay a discount, but it was issued for $100,000, so therefore the par value is $100,000 because that's what's going to be repaid at time of maturity. So if we look at this chart here, you see par value is $100,000, that's what it initiated at. And then at maturity, when it's paid off, if that's 30 years later or 10 years, 20 years later rather, then at maturity, you'll get back $100,000. However, a bond may trade at a premium. What if that bond was issued at $100,000, but initially it trades at $110,000? At some point in time, you have a bond that was $100,000, but somebody pays you $110,000. I'll explain why that could happen. They pay $110,000, but when that bond eventually matures, they'll only get back $100,000. Now, you could be in a situation where you pay a discount. When you purchase a bond beneath its par value, that's called a discount. And that discount eventually will give you some extra kicker at the end at maturity because you'll receive more money than what you initially paid for the bond. When you take a look at a mortgage bond coupon, you can see it incorporates some of these things. It's going to incorporate the coupon rate and the price, and the two will interact with each other, much like a seesaw. So if you took the current value of a bond minus its purchase price, that equals your capital appreciation or loss. So the purchase price of the bond will increase in value if market interest rates drop because you're holding an interest rate that's higher than the market interest rate. So people will pay you more for your bond because it's going to make it more attractive than available market rates. So, for example, let's take a 10-year treasury that was trading at 70 basis points, and you invested $1,000 to get that yield of 70 basis points. So now I've got a bond that's yielding me 70 basis points. How can I make money on this? Well, if the yield drops to 35 basis points 6 months later, well, cha-ching, I made some money. Now, this is just an estimate, but you can make a lot of what's called capital appreciation by holding a yield that's higher than the market rate. This is a very important concept for you to understand. It's just like if you locked in a customer at a certain price, or the customer is expecting a certain price, but then interest rates improved, the pricing on your rate sheet went up, so you have more money to give back to the customer. So remember, the current value minus your purchase price of what you paid, that's your capital appreciation. Now, what if it works in reverse? That would be your capital loss. Let's take a look at a yield to maturity. Again, a really important concept for us, and this is really going to kind of put things together for you. So if Barry lent Dan $100,000 in a bond that was at 6%, Dan would pay Barry $6,000 per year. But what if next year market rates rose and they went up to 12%? Well, the bond that I'm holding, is it still worth $100,000? Well, not really, because I'm only getting 6%, but everybody in the market's getting a much greater amount at 12%. So if I wanted to value it, if I wanted to sell it, if I wanted to borrow against it, how much is it worth? We could kind of take a look at the yield curve. So when we take a look at the yield to maturity here, what I want you to focus on is where the bond price is at par, at 100. And if it was at 6% at 100, the coupon rate is 6%, the bonds at par, let's just say this is a $100,000 bond. Notice that if interest rates were to rise, so we're going along that curved line to the right, the higher the interest rate, the lower the value, the deeper the discount that that bond would have to sell at in order for somebody to be interested. Because what happens is that over time, you're going to see that loss of interest rate. So for example, if interest rates went to 7%, I'm holding a 6% bond. If there's 10 years remaining on that bond, I'm going to lose 1% for 10 years. So therefore, I'm probably going to have to discount that bond by 10%. If there's 20 years left, I probably have to discount it more. If rates go up by 2 or 3 or 4%, well, you get the picture. The damage gets greater and greater and greater. Now, what happens if I have a bond at 6% and rates go down? We'll take a look at that yield curve on the left-hand side, and you'll see that you start to get appreciation. The longer the duration, the more years that you get that appreciation, the more money you're going to make on capital appreciation on that bond. It's a very important chart for us to understand how this works. The premium will be paid when the current yield and the yield to maturity are lower than the coupon rate. In other words, I got a bond and rates went down. You'll have to see that there's a discount if you want to sell. You'll have to discount it because if the current yield and yield to maturity are higher than the coupon rate that I'm offering. If I've got a 6% and the market's at 7 or 8%, that's got to be discounted. So remember, as rates decrease, prices on bonds will increase, and as rates increase, prices will decrease. In all cases, when that bond matures, the bondholder will get the amount of the face value of the bond. Duration, as I mentioned, is very important because what duration does is that will compound the issue, right? If you have a bond that is a market rate of 7% and the coupon is 6%, but there's only 1 year remaining, well, then I'm only going to miss 1%. So if I had to discount it, I'll only discount it 1% because it's going to mature in a year. And I'm only going to miss out of 1% for 1 year. So I'll get 99% of the value of the bond. But if I have 25 years remaining, well, that's 1% 25 times. There's probably going to be an awfully big discount in that bond by perhaps as much as 25%. So these are all things that come into consideration. Now, duration. The longer the duration, the greater the sensitivity, as I mentioned to you, because you can have more price volatility. The shorter the duration, even if interest rates change, it's not going to change the price of the bond that much. So a 30-year bond is going to have significant buying power erosion if you've got more inflation as well. So the longer the bond, the more price sensitivity that there will be. So you've got greater risk if rates go up, greater reward if rates go down. This is very important in understanding how to manage your own portfolio or to explain to a customer as to why mortgage rates are so sensitive. Sometimes people will talk about the Fed and they'll say, oh, look at the Fed funds rate or look at Treasury bill rates. Well, if something's out there for a day like the Fed funds rate or a year like a Treasury bill, that's very different than a mortgage rate that's going to be in place potentially for a much longer period of time and theoretically up to 30 years if it's a 30-year fixed rate mortgage. So when it comes to inflation, something that's got a short duration, even if inflation spikes up, it's not going to affect my buying power. Like, for example, a treasury bill that matures in 3 months, well, okay, how much am I going to get hurt if the inflation rate goes up a little over 3 months before the bond matures? But if I've got that thing for 30 years, well, that inflation over time can really erode my buying power, in which case I definitely need to see some additional compensation for that. That's why you have a normal yield curve where the longer it goes out, the more compensation usually is required if it's anticipated to see inflation. Now, if there's a potential recession coming, and we'll talk more about this later, what will happen is people think that prices might actually come down. So therefore, I don't need additional compensation for going longer. If prices are going to go down, well, I probably could take a discount for going longer because I'll have more buying power because prices will go down. That's when you get that phenomenon in an inverted yield curve. And Megan will talk to you about that a little bit later. So now, the sooner the debt matures, the less market risk that can happen. The longer it's out there, the more sensitivity to both the change in rates and inflation. So here's an example. If it matures in 1 year, a subsequent rise in rates will have a negative impact of 1%. If you see interest rates, as I explained earlier, go up 1%, then you're limited. You only have it for 1 year. You lose 1%. You're going to lose 1% of the value. But how about if it matured in 20 years? And now the rate that I have on the coupon is 1% lower than the market rate. Well, I'd lose out on that market rate theoretically 20 times. And that's why it's so much riskier when you have longer duration. But remember, there's more reward as well. So a drop in rates will have a corresponding positive impact for that reward. Now, there's something that's really interesting here, and that's called a callable bond. So what does this callable bond mean? It means that I can issue a bond, but I have the right to call it back at a specific time. In essence, to refinance it. Now, if you have a treasury, the government can't call that. That's out there for the duration. But if I issue a bond and I say one of the features I want is a callability feature, essentially what it allows me to do is if interest rates drop, I can refinance that and take that bond away from you that you were getting interest on. So let's see how that works. So a bond that the issuer may pay off or call before it reaches the maturity date has to state that. They can't just decide later on they're going to do it. You have to know going in whether the bond is callable or not. Now, this is a big benefit to the borrower because, again, if interest rates move lower, they can refinance at a cheaper rate, like a mortgage with no prepayment penalty after a certain period. Now, think about what you've learned. What you've learned is this. So if there's a bond out there that you say, oh, great, I have a bond with a 6% coupon and rates went to 3% and the bond has 20 years left on it, I'm in the money because I'm going to benefit by that 3% for 20 years. And initially, while that looks right on the face, if the bond has a callable feature, they'll typically limit it. They'll say callable after 5 years, after 8 years, after 10 years, whatever it is, that will be stated in the bond. Well, if the bond's been in existence for a few years and there's only 2 or 3 years left before they call the bond, I don't get the benefit of the gain on that duration. See, if rates are that much lower, the issuer of the bond, they're going to refinance it, just like a smart borrower would refinance the home. So that would make that callable bond, in order to get that callability feature, probably have to give you a greater amount of interest because you're not going to get the benefit of the duration. Now remember, it gives you a lot of risk as the investor because you could have lots of duration risk on a callable bond if rates wind up going up. I got a 6% bond, rates went to 7 or 8%. It's callable, but they're not going to call it. They love the fact that they're sitting at 6 and rates are at 7 or 8. So I've got that duration risk, but I don't get the duration benefit if rates go down. So something to think about. It can be very tricky and dangerous. Something could look good on the surface for you, but when you see that there's a callability feature, you as an investor for your own portfolio, you need to be on guard for this. So this has to be evaluated. This is something that you have to think about. And one smart way to do this is by taking a look at an example. So let's just say there's a 20-year bond. It's got $1 million par value. So there's $1 million borrowed, and $1 million is going to be paid back at maturity. Now, there's a 5% coupon yield, so there's $50,000 annual cash return. But later on, a year later or so, the current market rate is near 4%. Now that would normally be a great thing because I've got a 5% yield, rates went to 4%. Hey baby, I'm making a lot of money here on this thing, right? I should get a lot of capital appreciation, especially there's 19 years left. So man, that means I should be up like 19% in capital on this bond. I have a 1% benefit with 19 years remaining. That should give me a 19% premium estimated on this bond. But hold on a second. In this particular case, like we said, it's trading near a 20% premium, which means that if someone were to purchase this from me, they would purchase it with that 20% premium near $1.2 million to get that coupon yield at 5%. So what they're doing is they're saying, hey, I want a 5% yield. There's only a 4% market. Why would people do this? Because so many people are worried about income. And so many people are saying, listen, I need a higher yield so I can live off the income. And in their desire to do this, and you may fall into this situation because, listen, you're going to make investments in other things, in stocks and in bonds, and you're going to have a financial planner perhaps or a financial expert who's going to say to you, oh, I'll get you more yield. I'll allow you to have a fixed income that you would want. And then what you don't realize is you're paying these big premiums on bond because it's a 4% market, so the only way they can juice it to 5% is to get you that 5% coupon out there that you have to pay a premium for. Now, if there's a callability feature, you've got some big risk. So in this case, let's just say, for example, that it's a 20-year duration, but it's callable in 8 years. Now, if rates are lower in 8 years, you know the issuer of the bond is going to call this thing back. It's over. They're going to refinance it. So if the investor is going to pay $1.2 million, remember, when that bond matures, they're going to get $1 million back because that's the face value. You always get the face value at maturity. But also, if the bond is called, they're going to give you just the face value. They refinance it and they pay off what was owed. The fact that you paid a premium, tough luck. So what would happen? If we know that because rates are lower, this bond is going to be called or refinanced to save money for the borrower, let's think about what we got on this. So the return from the coupon over 8 years was $400,000. Remember, you're going to always get the stated return that's on the initial face value. The initial face value is a 5% coupon yield on $1 million bond, so it pays $50,000 a year. If you have it for 8 years, $50,000 for 8 years, that's $400,000. Seems like a good deal. I made money, right? Well, not so fast, because you paid a premium on this of $200,000. So you did make $400,000. You got a haircut. You paid $1.2 million. You got a haircut of $200,000 because you only got back $1 million, so you lost that premium. So you netted a real profit of $200,000. And that $200,000 profit on your $1.2 million investment, over the 8 years, that's 16.7%. So your annual estimated return for 8 years is really 2% or 2.1% in this case. Much, much lower than what you thought you were getting when you signed up for a 5% yield. And this is the way that financial planners either miss the boat or try and get your money and try and put you in the wrong investment for yourself. Now, can this help your mortgage customers? Of course it can, because your advice and your knowledge and your expertise, it really can make a difference. But where this really can help is for you, for your own investments. Listen, most people, as they are a little younger, they want what's called capital appreciation. A little bit riskier. Some people prefer stocks because they are riskier, but you have time to correct those riskier periods, and over the long run, you'll make more money typically, not always, and there's no guarantees, in the stock market. But as you start to reach an age where you're nearing retirement, you have less years that you can put yourself in a position of those corrections or living through those dips. So instead of capital appreciation, you're more concerned with capital preservation, and you tend to look at things like bonds. And as so-called financial experts start to tell you these things and say, oh, I'll get you this income, please be aware and careful of callability features, because there's many times where people have gotten burned, and gotten those nice yields taken away from them much sooner than they anticipated and lost money on that. Now, this brings us to something that you see sometimes in the bond market where people scratch their heads. Now, Austria said, hey, we're coming up with a 100-year bond. And recently that showed a return of 0.88%. Let me ask you something. Would you put your money away for theoretically 100 years to only get less than 1%, 0.88? Why would you do that? Clearly, you're not thinking about this to get the income stream, but you could still make a lot of money. See, it's a bet. It's a bet that rates go down. Why? Because you can make significant capital if rates fall. Now, before I tell you, I want you to think about why. I'm going to give you a second here. Think about what you've learned. Think about why would you invest in a 100-year bond that's only at 0.88? How would you make capital? What would happen? So if interest rates were to drop 0.5% theoretically, well, you'd get 0.5% as your yield, which is 3.
I just want to address something real quick because you might be thinking, oh, why are we going through all of this? This is why the oversimplification that I've given you guys before, where if rates are if inflation's at 8%, like, why aren't people searching for a yield that's at like 9% so we can get an 8% coupon? It's impossible. First of all, that investment doesn't exist. But why would somebody be willing to take, let's say, a 5% coupon or 5% rate of return on, let's say, a 6% mortgage, like investing in mortgage-backed securities? They'll still buy that if they think that in the future inflation will come down. So yeah, you're not going to find a rate of return that's going to outrun inflation, especially since we're going to be like 1% above that. Remember, the coupon rate is usually about 1% below the coupon rates what the investor's actually receiving. The mortgages that are part of what that mortgage-backed security is about 1% higher than the actual investor's coupon rate. So you're not going to be necessarily searching for a 9% interest rate if you think that rates will come down in the future, but you're going to need something to make those look attractive. So this is why people will still buy mortgage-backed securities to some extent. It's still a safer rate of return.
They think the rate's going to go down, they're just going to offload it.
Well, they'll make money when rates come down off the capital appreciation, so they'll sell the one. They're not going to keep it for maturity. So that's where this comes into play, where nobody's going to want a 0.88% rate of return. With the capital appreciation, if rate changes, that's going to be compounded over time. Potentially.
So right now we're just trying to combat inflation, not trying to lose everything, but you don't mind losing for now, and then you sell it at a premium.
Well, that was the only reason. That would be the only reason to invest.
Okay, so like, how does the callable part go into
that? That's not. Yeah, I mean, we don't worry about that.
That's just for other
securities.
Bonds.
That's just more for something that it's good for you to know, because I have conversations with my clients all the time about finances. I talk to a lot of financial planners, and like Dustin's financial planner, when they start saying something that I know is wrong, and then I call them out on it, and they're like, "Oops, I pretended to be an expert, know everything I'm talking about, and I was trying to bully you guys around, but this guy just called me out on my shit." Remember
The Mexican guy?
Yeah,
Sergio.
whatever his name was. But yeah, so like he was telling the client something, and I was like, no, that's not true. And then we kind of went.
Guy was an idiot.
Yeah, he was an idiot. But it's important for your client.
So he's fired, I'm assuming.
He's probably not worth it.
Oh no, she's still using her because she's an idiot too.
Oh. But anyway, I wanted to just mention that, because that's why this is actually still.
3/8 cheaper, 0.38 difference. So that would be the benefit. You're holding 0.88, but the bond market for this particular bond dropped to where it was only yielding 0.5 for anybody who purchased it new. You now stand to profit greater than where the market is, because you're getting 0.88. The new market would be at 0.5. That 0.38 difference would be your benefit over the market for 100 years. That would give you capital appreciation of 38%. How do you make money in the bond market? How do you make money when you're getting less than 1% return? Well, if rates go down on a long duration, you're going to make an awful lot of money. And that's why this is so important to understand. And that's how duration plays a major role. Now, I'm going to get into something here that's a very important way to forecast interest rates, and it's called convexity. Now, don't panic. I know that it's a fancy name, but convexity buying is one of the ways that we have accurately forecasted the direction of rates. Look, when we saw things changing and happening, you want to know why we're able to ride the bond market and ride rates going lower before issuing false alerts to lock and telling people to lock at the wrong time, causing all kinds of problems for their company? It's understanding periods of convexity. So you see the 10-year Treasury and mortgage-backed securities, they're different. Mortgage rates are based on mortgage-backed securities, but there is a relationship between the 10-year Treasury and mortgage bonds. And convexity allows us to see that relationship and capture the momentum so we can make really smart decisions when it comes to locks, and even smarter decisions when it comes to not locking. Let's let you in on a secret. So here we go. Now here's what I want you to do. I want to make it so that you imagine yourself as a fund manager. So you're out there and you are managing bond funds right now. And because you're this great bond fund manager, you are going to try and raise capital. Now you can't just willy-nilly this thing and say, hey, invest with me. I'll put it in whatever bonds I want, and whatever which way the wind blows today, that's the kind of bond that I'm going to put your money in. Why would that not work? Because we just explained the longer the duration, the more what? The more risk, the more price sensitivity. The more you can make, but the more you can lose. Now, what if you don't want to risk all that money? Even though there's a reward, you can't afford the risk. I don't want a longer duration period. But what about short duration? Short duration, a year, 2 years, very little price sensitivity. So you're not going to lose a lot of money, but you're not going to make a lot of money either. And you might say, hey, I have a little more appetite for risk. I don't mind taking that risk. And then there's kind of intermediate, which kind of is in between. So intermediate term is deemed to be like 4, 7 years, right around there. Now, this doesn't mean that every one of your investments has to be between 4 and 7 years. It just means the weighted average. You might have some longer ones, you might have some shorter ones. And as we look at this, you can now disclose to your investors what they can expect. Is this going to be a shorter duration fund? Little risk, little reward. Longer duration, a lot more risk, a lot more reward, or something in the middle. And let's say your fund is medium duration, 4 to 7 years. So you've got some mortgage bonds in there. You've got some treasuries in there. Now, what happens if we get into a refinance environment where interest rates start to decline? Now, you're thinking your mortgages typically sit there for 4, 5, 6, 7, 8 years, right in the sweet spot of where your duration period is. So you've been buying a lot of mortgage bonds, except now rates went down. So what happens? What are you doing when rates go down? You're refinancing the world. And as you refinance and refinance and refinance people, their mortgages don't stay on for 4, 5, 6, 7, 8 years. How long do they stay on for? A year, 6 months, 10 months, 2 years? So your duration starts to do what? It starts to shrink. Now, you promised people that you wanted an average duration of 4 to 7 years. So you're not really doing that. How do you lengthen the duration? What would you do to lengthen the duration? Well, you can't do it by buying more mortgage bonds. Why? Because if you're buying more mortgage bonds, you're in the same boat. That's a shorter duration. That exacerbates the problem. So you do something that the duration doesn't change when you purchase additional things to your portfolio, and you probably guessed it. You want to purchase some 10-year treasuries. So the 10-year treasury will give you a longer average so that your mortgage bonds may be paying off in 2 years, your 10 years paying off in 10 years, because remember, those aren't going to shrink. They're not going to refinance them early. And now you're right back to about 6 years average duration, right in the sweet spot. But thinking about this, everybody who's got an intermediate term bond fund, you and all your colleagues, as you all start funneling in because people are refinancing to buy more 10-year treasuries, what do you think happens to the 10-year treasury yields? Everybody's buying 10-year treasuries with both fists. The price goes up, and when prices go up, what happens to yields? Yield falls. The price goes up because everybody's buying it. They're crowding others out of the market. There's a greater demand. I've got to have it. I've got to have it. And they're bidding the price higher, which takes the yield lower. Now, when the yield on the 10-year treasury starts to go real low, other fund managers look at the overall market and say, where should I invest? Should I invest more in treasuries, like the 10-year, or should I invest in mortgage bonds? And there tends to be somewhat of a range where the 10-year treasury and mortgage-backed securities have a relationship. The 10-year treasury is backed by the full faith and credit of the U.S. government. It'll always be lower. And then mortgage bonds, because of the little bit greater risk, are going to trade higher than that. But if the 10-year treasury starts coming way down, that increases the spread between the two. So mortgage bonds look like a better deal. So what does everybody else start doing? They start buying more mortgage bonds. And as they purchase more mortgage bonds, what does that do to the price of mortgage-backed securities? The price of mortgage-backed securities goes up. And what happens to the rates? Rates go down. And when rates go down further, what do people do? They refinance. And as they refinance, what does that do to duration? It shrinks duration. What do bond fund managers have to do? They got to buy more 10-year treasuries. And you get the picture as the cycle perpetuates itself. Understanding this concept of convexity buying will really help you from getting burned by locking in and only to discover that interest rates start falling dramatically. You have to look for these periods of convexity and understand it so you know what to do, so you can explain it, and so that you could protect your customer and you're not looking at a problem with it later on. I know that this is an important concept, and I know that it's a new concept, but I want you to perhaps listen to this a few times and it'll come to you. But convexity buying is a really wonderful way to protect yourself from being put in a position of seeing interest rates fall dramatically, and you've all been there, and you being on the wrong end of that trade. So we got to watch for convexity buying.
So I put it. And what in practice,
So
like,
when
what
I'm,
would I do to identify that?
so you're gonna be looking, so you go in my office any time of the day, you're gonna see mortgage-backed securities up or 10-year treasuries. So when I'm looking at mortgage-backed securities, I'm also looking at some of the indicators on the trend of the 10-year treasury. Because I know if, let's say, there's a ceiling on the 10-year US Treasury, so we might be able to keep a cap on treasury yields. That means that I can probably be a little bit more aggressive on my stance, like my floating stance, because I don't think that if let's say if we just broke through a ceiling, like on the 10-year treasuries, let's say we broke through like an important ceiling, let's say 25-day moving average or something important, or Fibonacci retracement level, not like just a loosely identified level, but let's say something important, and we break through that, and I'm looking at mortgage-backed securities or mortgage bonds, I can see the fact that we have a lot of room to run in yields on the 10-year US Treasury may exacerbate any movement in mortgage bonds. Does that make sense? Like, or vice versa. So let's say, like right now, I was looking at the mortgage-backed securities. Now there's a ceiling of resistance that we're up against, but but the 10-year US Treasury just fell below an important like floor, or it's opposite. So an important support level or like a resistance level for them to come down. Now, if you're going to look at that for trends and the momentum of rate reductions, and that might directly impact mortgage bonds. Like,
So you're looking at the rate, you're looking at the bonds. By looking at the bonds, you're deciding whether or not you think in the next week or however long that rates are going to continue to go up or continue to go down. So you lock it.
I think that, I mean, we're always looking at mortgage bonds for pricing, like today's pricing, immediate pricing, yes. But if we're trying to see if any trend could be exacerbated, one thing we want to do is see where we're trading on mortgage bonds. If we're trading in treasuries, we're looking at treasuries and they're trading between like a really narrow margin. Let's say they're trading between like the 25 and 50-day moving average, and it's really tight. And we know that if, let's say, rates started going up, let's say mortgage bonds started decreasing, and there was another like a floor support that we were going to go butt up against, and I'm looking at the treasuries and they're trading within a really tight margin, it's less likely that we're going to have an exacerbation of that downward movement of mortgage bonds and mortgage bond prices. You're also going to look at like the stochastics, so you're going to look at like the trading volume, how if you're oversold or overbought, because that can also make a difference. And there's something called the positive and negative stochastic crossovers. But I think they'll be getting into all that kind of stuff too. But it's more of momentum, not necessarily.
Yeah, looking for the momentum, sure. And in your experience and in practice, like as far as it goes for us and locking rates with our clients, what time frame are you looking at? Like,
What do you mean?
Like when you're looking at for this momentum and stuff, like is it typically for us specifically in our industry, like we only really matters if it's like a week time frame, like a month time
Oh, yeah, yeah. So I mean, you're,
Like when we're dealing with clients, like we're deciding, okay, what's rates gonna do? Am I gonna lock? Do I got some time to flow? Like what the hell's going on? Are you thinking like in terms of like a week, 2 weeks, 3 weeks, a month?
I'm
2
talking
months?
like 2 days to a week.
Okay,
That's
so-
about as long, because
Okay, that's what I, yeah.
these charts, the importance of the charts, and actually, let me pull that up. I'll just pull up the chart real quick here.
I think that's important context.
Yeah. let me do this real quick here.
So 2 days to a week.
And it depends on what news is gonna come out, because all this goes out the window when, all this goes out the window if if new economic data comes out. So, let's see here.
Facebook's metaverse died.
So, I'm gonna share this. Let me-
Popcorn's really good.
Somebody on the Zoom, kind of tell me if you can see the screen with, or is it, Jason?
I see it.
Is it, okay,
MBS Highway.
is it MBS Highway? Small, okay.
How much is MBS Highway?
I don't know, I think it's like $59 for like the regulars. The basic subscription. Okay, so you see right here, so mortgage bond, this is the 4.5% coupon. So it's this right here. This is your coupon rate. This is what the investors are getting. So this is 4.5 coupon, is for like 5% or 5.5% rates. You can click this, we can show you some more coupons. That's 5, so that's whatever 6, but these are, and then GNM, that's Jenny Mae coupons, those like for FHA VA loans.
So this is just like you know, ones that you can invest in right now, like there's certain tickers,
Yeah,
what those represent.
Exactly.
Okay.
So if I'm looking at so when my clients right now are telling me, should I lock? Well, I see, okay, so right now pricing is at 99.31, okay? That's current MBS pricing. And I'm looking here, so this is a resistance level. This level right here represents our low on this day, on June 10th. So see this wick that ends right here?
Mhm.
That is basically like the low of that day. Now the market rejected pricing there, but it did drop to that. So this is these like this right here is something that Barry identified, and he puts this on our charts to make it easier for everybody. So now I'm gonna find these things yourself. But
With the resistance levels.
yeah, resistance support level. So these like this right here is a 0% Fibonacci level. Remember you see a percentage right there, and then these are simple moving averages. So you got your 25-day moving average, 50, 100, and 200-day moving average. But when I see this, I see, okay, we've got potential before hitting resistance at 100.62. And if we're at 100.31, we have 31 basis points potentially to the upside, right? So does that make sense? So like 31, so 99.62 minus 99.31, where we're currently at, 31 basis points, right?
Mhm.
So this is actual pricing. So let's say today we're at 0 points for a certain rate. If we made up this difference, you might get like 31 basis points credit. Does that make sense?
Mhm.
Or let's say something costs right now 31 basis points. But if we move up a little bit, we get a little bit of an improvement, we get up to this resistance level, you might be able to get that same rate that was going to cost you 31 basis points at par for free. So I might say, okay, yeah, I mean, I don't want to charge this person points. I want them to pay 31 basis points of points, or a third of a point. But I have to balance that with what's my downside? What's the risk? And the risk is at 98.0. So if I'm talking to people about locking, and I just talked to the new escrow today, we went into escrow earlier today, I'm not going to risk them telling them, okay, well, yeah, the thing about our lock is we didn't lock, and then we just dropped all the way back down to 98. Now what I could have given them for free, like at par today, will cost them 130 basis points, so 1.3%. Anybody want to have that conversation? Anybody?
Nope.
Yeah. And how much worse is the conversation, even if it was the same amount? Telling somebody, oh, I got you a 25 basis point credit, or not, or let's say I got half a point credit. They're like, oh, great, what does that mean? 2,500 bucks. Oh, that's good, 2,500 bucks. Or, oh yeah, I was gonna lock it and I didn't, and now it's a half a point cost. They're like, oh, what does that mean? 2,500 bucks. Oh, I gotta pay $2,500 more. That dollar amount seems so much more when it's costing that versus going to a closing cost.
I literally had to have the same conversation with the client that came in last Wednesday, where I suggested for them to lock, they didn't lock. It, the cost was $728 last Wednesday. She's paying $10,000 now.
So, I'm sorry, like, is that like red line now, like the resistance for you now?
What? Yeah, so this is a low, so this is
Right.
mortgage bond pricing, so this up is good.
Right, and so
Yeah.
like, you know that since you approached the new resistance, you're saying like, hey, like, I'd rather just lock it.
Because it's
But
more
before that red line wasn't there, until that candle's rejected, that before.
Uh-huh.
And so the line above this red line, I don't know if it's purple or something,
that one.
that used to be your
Yeah.
support.
Yes, well, yeah, that used to be because that before this, before the 10th, that was our lowest level right here, which represented our 76.4% Fibonacci retracement level.
So if that's what it's saying, as the price goes down, it can't go down, it was saying it couldn't go down more than that at the time, like. You
But
would
that's when if you introduce new economic data, like last Friday, we had,
So then you'd be like,
CPI.
the support's no good anymore.
then it goes out the window. That's why we only can project a certain amount of time. And what's important is that, see all these lines that we trade between these, I mean, this pretty much holds up a lot until some exogenous factor comes out. Numbers. What's important is that not only am I following this, or other people following this, but the most trading is done algorithmically, like it's all done by computer, and the computers are looking for this. So they're seeing this, and when you have like massive trading that's following these, it's more likely to continue to follow these trends, right? Like there's these patterns. That's why these patterns are important, because this is what all trading is done based on people's speculation on what's going to happen. If everybody thinks that things are going to trade within here, a lot of the actual movement is going to happen within this. But if you have, big numbers coming in inflation, like the CPI data that came in last week, PPI data that came in like earlier this week, that could throw this all out the window. That's why you can't really project unless if there's new information coming in that can affect things. So does that make sense to everybody? I can't see right here. Now this is the 10-year treasury. Let me see here. I'm not gonna go on it. So see right here, we just broke through this Fibonacci level. Now, if we broke through, so that just to answer your question, sure. So see how there's a lot of room for this to run right here, if things get better. So we ended, we're closing under this 24, which is an important level right here, 3.24%. Yeah. So if we get more follow through here, there's a better chance
The momentum will continue.
that the momentum will continue through.
These are day candles.
These are day candles. And there's intraday candles too, like there's intraday charts you can look at too. And like when I'm looking at pricing, so it's 11 o'clock Eastern. So I'm trying to figure out, is there going to possibly be a midday? I know our pricing comes out about 8 o'clock Pacific time. So I'm looking at 11 o'clock Eastern. Now, if that's 6 basis points, we're not going to get any change. But if we get to about 20 basis point difference, up or down, I know there's probably a decent chance of us getting a midday change. So when Cynthia comes over or Dustin comes over, or there's a chance we're going to get a midday improvement, I'm not looking at the day, like the full day change from yesterday's close. I'm looking at from when pricing came out. Because if pricing came out, let's say at 7 o'clock or 7:30, let's say there was a 22 basis point change. If that maintains for a while, that's if we sustain that kind of improvement over when rates came out, yeah, there's a good chance things are going to change. Like we're going to get an improvement or deterioration if that was the opposite direction. Does that make sense? Like it's based on.
It makes sense, but it's one of those things you have to.
It's not like,
Continually. go
yeah,
over.
like I wouldn't be able to, like, I
Well,
don't think, like,
you'll, as you learn it and you continue to follow it, all this stuff kind of patterns kind of make sense and they kind of just kind of feel it. But this last thing I'll just mention before, and is this right here, these stochastics. So this is,
Do with the mouse so that this.
Like RSI or something.
so this, well, so if we're up here at this level, because brown, right?
Right.
That one is, if we're under here, that's oversold territory. That means that if there's an improvement, a lot of times we can actually get a little bit more of a little bit more momentum behind it. Now if you see right here, this is where the black line crosses over the red line. This is called a negative stochastic crossover. And a lot of times that will mean that any movements in the market will be exacerbated. So you see that we broke through here through the 25-day moving average and things got worse. This was because we had a negative stochastic crossover. This usually, it's not because of that, but this is if you have a negative stochastic
Leading
crossover,
indicator.
it's an indicator. Now we're in oversold territory coming back up, but as we get closer to this halfway mark, we might have a little bit less momentum if things start improving. So the classes will get a lot more into watching the charts and different pattern formations and how to identify like what's happening with these candlesticks. But at least right now, I would say that the key takeaway is these are related in terms of momentum, but it's good to know where these are at today because most people, like 99% of loan officers, I would say, at least 95% of loan officers, they're looking at this and they're looking at this from yesterday because they don't have this up. And so they're not only do they think that mortgage rates, almost every loan office you talk to thinks that mortgage rates are directly tied to the 10-year treasury. That's what everybody's always been told. They're looking at this and they're looking at the data that came out this morning from yesterday. So by just looking at this in real time, they're behind. They're a day behind always. And if you look at just this, even if they were looking at this today, they would be wondering scratching their head, why are rates not better? And if you run different calculations, you run a correlation both on mortgage bonds and the US Treasury or the 10-year Treasury, every single day it's a moving target. It's not always, you're never going to come up with like an exact number. If you want to know what that calculation looks like, I've actually done it. That's what it's like. I'm actually doing it by hand. I don't have SPSS.
Jesus, what the hell?
Yeah, Jared might actually understand that a little bit. It's just economics background, but
That's like a long time ago. I was like, anything like that.
so I may build any questions anybody's got. Remember any of that, Jared?
I haven't done this in a long time. But I've definitely done it before.
So, all right,
Just
Renee, good.
It was I still need to wrap my head around it. That was awesome though. Thanks for the explanation and the
Yeah, and I'll think I need to try to come up with a reporting for their models that you didn't see because it helps tie us all together. But I'm getting looks from Aileen that I need to get back to so long. So thanks, guys. See you next week.
thanks, Josh.
Thanks. Oh, you know I forgot to record this one.
No, you didn't.
Nice. The most important one.
No, you didn't, did it?
No.